about money with your AFC team, Mike, Chris, and Al on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com.
We have a question. What is the role of the Federal Reserve? More broadly, the question is, what's the role of all the central banks in both the developed and emerging countries? It's something we've been discussing at Adams Financial Concepts. And when you think about it, Sarah Bloom Raskin was nominated to the Fed by Biden, President Biden, and essentially forced to withdraw over her views about what was the purpose of the Fed. In the midst of quantitative tightening following quantitative easing, these moves by the Fed may affect your life and your investments. So what is the purpose of the Fed? We're going to discuss that. And if we have time, we're also going to discuss what a luncheon speaker had to say about you as a client. During this talk, he said that clients have changed their views. Clients held certain views of investing in life before COVID. During COVID, those views of life and investing changed. And now as we're coming out of COVID, those views of life and investments have changed again. We're going to talk about what he had to say and why he said it, and what we think about that. We have that and maybe even more. But we want to begin by talking about the Federal Reserve and central banks in general. The first central bank was the Swedish Riksbank. First central bank set up in 1668. And the purpose was to maintain the domestic coinage at its fair and right value. They didn't have paper currency in those days. Everything was a coinage, a piece of silver, a piece of gold, a piece of copper, a piece of tin. That was the coinage. That was the currency of the day. And that bank was set up to maintain the domestic coinage, its fair and right value. The Bank of England followed it in 1694, 30-some years later. Actually, that was 26 years later. And that was set up to fund their war against France. So we've had central banks for centuries.
In 1913, the United States decided to adopt a Federal Reserve Bank. They didn't actually take action until 1914, but that was a result of the panic of 1907. In 1907, when the stock market and the country was in panic, it was J.P. Morgan who came to the rescue and went to the president and was going to bail him out with $100 million loan, because at the time they had to keep a reserve of $110 million. That was the government's goal. That dropped to $60 million, and then it dropped to $45 million. And Morgan went to them and said, "Hey, I'll bail you guys out," when they were at $60 million. And the president at the time said, "Nope, we're fine." Then it dropped to $45 million, and he got in panic mode. So Morgan ended up buying $60 million of U.S. Treasury bonds to bail out the government. And so this spurred, can we have one guy who can basically come in and bail out the government? They didn't want a system like that in place. So 6 years later, we adopted the Federal Reserve. Now, what type of job did they do? That remains to be seen. There's a lot of speculation. A lot of people say that they really didn't do that good of a job if they got a really bad track record.
Yeah, and when you look at it, there's three primary purposes of the Fed, right? The first is controlling interest rates, right? Slowing down the economy based off the market cycle we're in. Second is basically keeping, how much do the banks have to hold in reserves? Is it going to be 5%, 10%? They control that, which ultimately, is going to control, how much the bank can lend out, and it's either going to stimulate or slow down the economy. And then there's QT and QE, which is, said simply, whether the Fed's buying bonds or selling bonds, and whether it slows or stimulates the economy. So those are the three primary purposes. Now there's a lot of debate, and this is something we've debated in the office: is are they getting distracted from their primary goal, and are they starting to focus on things they shouldn't be focusing on?
But if you go back even before the inflation period of the 1970s, the real purpose of the central bank was to be the lender of last resort, right?
Right. But in those crashes before 1929, there was a panic again in 1920, 1921. And, history says the Fed really didn't do its job then as being the lender of last resort. They didn't do a job of managing the money supply, and that's why they had those crashes. The same thing in 1933 when the economy was tanking, the Fed, they actually tightened the money supply. So what have they done and how well of a job they done? I don't know.
Yeah. Well, during the 18th or 19th century, during the 1800s, we had the Bank of England that helped to bail us out and the Bank of France that helped to bail us out of a couple times. And the Fed came into effect with the idea of being the lender of last resort. Mm-hmm. But as you raised the question, Chris, it became the roles expanded.
Mm-hmm. And I don't want, and these issues that we're going to be talking about here in a sec are very important, right? So what we're seeing the Fed beginning to look at is climate change and inequality, and these are huge issues. I don't want to take anything away from that. But is it the federal government? Is it the Fed's responsibility to be addressing these things, or is it Congress, for example, that's actually supposed to be making these laws?
Yeah.
Well, that's the question. I think we're confusing fiscal policy with monetary policy, right? Monetary policy, as Chris said, was strictly controlling the money supply, supplying money to the economy when it's needed, and pulling back when it's not needed. And confusing those roles is a really ambiguous place to be.
So I'm old enough. I remember the 1970s and the inflation that happened at that time. And when Paul Volcker became chairman of the Fed, began to raise interest rates to cure, it wasn't just inflation. We were having stagflation. We were having a recession and an inflation at the same time. And coming out of that time, that was a time in which there was a worldwide stagflation. And coming out of that time, the big push on central banks was to control and be the lender of last resort. It was to control the reserves and facilitate bank lending. And at that time, all the central banks began to set targets for inflation.
2% was their target.
2%. And almost every central bank, developed world or the emerging world, had a 2% target. Mm-hmm. Chris, you looked at some of the chairmen of the Federal Reserve.
Mm-hmm. Yeah, I've actually been looking. There's about 16 of them that have come through since inception, and it's interesting to see the Fed chairmen that have lasted and the ones that have kind of fizzled out over the years. When you think of some of the better chairmen, you think of the ones that had some kahunas, that were willing to stand up to the president and say, no, we need to raise interest rates when maybe when in a rising interest rate environment, that's not good for the economy, right? It typically slows things down. And so that is the job of the federal chairman. And so naturally, a lot of presidents are going to dislike this. It's going to hurt them, right? Especially when re-election comes around. And so some of the best Fed chairmen, Greenspan, Volcker, these were guys that, didn't succumb to the pressures of the Oval Office. They stood the course. They put the earmuffs on, and they didn't succumb to the pressures.
Well, even before that, besides the interest rates, there's other things that bankers wanted to do, like in this book, House of Morgan, the rise of J.P. Morgan, all the way up into the 80s. It talks about the head of J.P. Morgan. They wanted to repeal the Glass-Steagall Act, which basically separated investment banking and commercial banking, and they put pressure on Volcker to do that, and Volcker wouldn't do it. Volcker said no. And they thought he was going to do it because he was, friends with a lot of the head of the banks, but he wouldn't do it.
But eventually, it did fall.
It did fall. It did, but it wasn't under Volcker that they did it. It wasn't until I think 96, 97 that it did finally fall.
Under Greenspan.
Yes.
And there was a reason. I mean, if you look at what's been going on between the banks. Banks had a large number of assets and a low return on assets. Brokerage firms had fewer assets, but a much higher return. Mm-hmm. When things were going well, they made a lot of money. But for me, it was a real difference of cultures, because in a bank, you never got in trouble for the loan you did not make. You know, if you didn't make the loan, it didn't ever go bad. In the brokerage business, if you don't make the investment, you never make any money.
Right.
So the banks were a culture of no, and the brokerage firms were a culture of yes.
Well, right, and it's like if we go back to even to 2000, right? When we think about what led up to the financial crisis in 2008, and that the banks started, in the Federal Reserve were involved in creating these, collateralized mortgages and things like that caused that crisis. Because the reason why, it goes back to what Chris said, is that, okay, they're getting involved in, the Fed's getting involved in doing more than just controlling the money supply, so they got involved in trying to create more home ownership.
Yeah, we're coming to commercial break, so don't go away. We're going to continue this conversation, because what we're talking about will certainly have an impact as we talk about what the requirements of the Fed are. What we're talking about extends to central banks across the world. And if you look at what's happening right now, it seems like there's 5 areas in which banks are being pressed to do more. They're being asked to intervene in the financial markets. They've been doing that for a long time, since the beginning. But now they're being asked to tackle inequality, income inequality. They're being asked to tackle climate change. They're being asked and tasked with dealing with digital currencies and to react to geopolitics. And so let's talk about those areas. I'll let you guys talk more about that.
Well, as we talked before, Chris, we talked about them tightening back in 2015, and I found some interesting stuff on that. Why they stopped tightening in 2015 was there was a crisis in China where China's yuan was dropping, and it was Janet Yellen who stepped in and said, we can't do what we need to do now and keep raising interest rates. We have to basically come in and help China.
That's really interesting, because, I had a lot of questions about that too. 15 was finally, what was that, about 6-7 years after the 2008 financial crisis, right? And so you would expect by this point, personally, in my opinion, I think 2012 they should have started raising rates, but you would expect by this time for rates to be increasing. You would expect for them to start to offload the $3 trillion that they had on the balance sheet. But it's very interesting that they didn't start raising them until 2015.
But it was really 2017 that they began to offload the balance sheet and really raise rates.
Right. Well, in 2000, think about this. In 2008, their balance sheet was $800 billion. And it went from there to 2013 to $4.5 trillion.
Mm-hmm.
And then they started to tighten a little bit in 2015. And then, as Janet Yellen says, in 2015, the devaluation of the yen caused the Dow to drop 1,000 points. Yellen making reference to the global economy, that we're in such a global economy right now that we have to watch. All this is interconnected, and we can't just deal with what's going on in the United States.
Well, what's another interesting is 2018. We're coming up on an election year, right? We're about a year away. We were supposed to be raising rates this time. There was forecast throughout 2017 that into 2008 or 19, there would be 3 interest rates that would hike, but this didn't happen, and it makes me wonder, why did it not happen?
So you looked at that too. Why didn't it happen?
Well, this is, you don't want to sound conspiracy theory-esque, right? This is, you want to stay completely away from that. But if you remember that at the end of 2018, it was Christmas Eve, the market took a huge crash. Well, what also happened in the news cycle during that exact same time? Well, you had Powell that was getting threatened. He was being threatened by Trump. He was getting fired, right? And this is a theme that we had seen over time, right? Greenspan says, I have a pretty good quote right up here from him. He said that The best thing that you can do if you're the Fed chairman is to put on earmuffs and just not listen. I do not recall a single instance where somebody in the political realm said we need to raise rates. They're too low. Never has a president ever said that, right? Because it slows things down and makes you not look good, right? And so naturally, 2018, we're getting ready for an election year. Well, what happens? The economy starts doing poorly. We're raising rates. It just looks like Powell got a little soft.
I didn't realize this, though, about the Fed, Mike. They have a self-imposed restriction about buying individual bonds.
They did.
They do, right? So what do? They were buying bond ETFs. They own $1.9 trillion in bond ETFs. I have the list right here. This is out of Yale University, an article I read. They own the iShares Intermediate Term Corporate, iShares Term Corporate, iBox US Dollar Invested Grade, Spiders Portfolios, iShares, Vanguard Intermediate. What's going to happen when they start unwinding this balance sheet? And what's going to happen to the bond market? Because when they bought these things, interest rates were down. Now the bond prices are up and fluctuated. How are they going to unload this without basically crashing the bond market?
Well, remember what happened. We're in 2020, March of 2020,
Mm-hmm.
and the markets are seizing up. The markets are crashing, and you have mutual funds, you have institutions that don't have liquidity. So how do you create liquidity into the system? You get the Fed to buy bonds, and that gives the institutions and mutual funds cash, which they can turn around and buy stocks. So what happens? Your question is, what happens when you reverse that process? You're taking liquidity out of the market.
Right, but I mean, the massive amounts that they have, I just wonder how it's going to all play out.
I think there's been a recent information from Jeremy Siegel, who's always been a positive person on the market. He's really concerned about the Fed tightening too quickly because they're going to be taking a 1.1 trillion out.
I mean, this whole quantitative easing thing, this only started in 2008. I did try to do some research. When did the Fed ever do quantitative easing and buy bonds in the market? Before that, they never did that. That was something that Ben Bernanke did in 2008 in reaction to the downturn in 2008.
Yeah.
Hadn't been done before that.
No, but Bernanke's thesis and Bernanke's study was on the Great Depression.
Right.
And he realized that one of the things that needed to happen in the Great Depression of the 1930s is to create liquidity in the market.
Right.
And so that was what Bernanke did with quantitative easing.
Mm-hmm.
But now we're faced with tightening to get out of what we did in 2008 and 2020.
No, was Bernanke right? I mean, did he do the right thing by raising? Or I mean, he loaded up the balance sheet with almost $3 trillion. Was that the right thing to do?
I think so. I think that kept us in a great recession rather than a great depression. I think things could have gotten a lot worse. If you look back in history, if you look back to the 1870s, when we faced a crisis, there was no central bank to bail us out. We had the first Bank of U.S., which had a 20-year term back in the early 1800s. When that expired, they made the second Bank of the United States, and Andrew Jackson was adamantly opposed to renewing that charter. So we didn't get a Federal Reserve until 1913. But from 1870s until 1913.
My argument to that, Mike, there was two main panics. There was the Panic of 1873 and the Panic of 1893, and both were precipitated by the railroads by crashing, and then about 18 different banks crashed during the 1893, and it was Morgan and a couple bankers that kind of held everything together. But we still had that. But look at, even after we get the Federal Reserve, we still had the Panic of 21. We still had the crash of 29. We still had the crash of 2008. And as Milton Friedman said, And is what's the use of the Federal Reserve? They don't have a really good track record. If they were a sports team, we wouldn't go to the games.
Yeah.
Actually, I go to the Mariners. So even
Well, maybe Mike will go, but the rest of us will stay home.
Yeah. Well, if you look at some of those healthy years, I know 94, 95, 96, those were some pretty decent years for the economy. If you look at interest rates, they were right about 5%, 5.25%. So my question is, what if hypothetical, what if we eliminated the Fed and just always had 5% interest? I mean, what would happen? Hypothetically,
maybe nothing, but hypothetically, maybe it would be like the 1870s, 80s, and 90s. And we did have only a couple panics during that time, but we had a really severe economy. If you look back in the 1870s, the wealth that was created, there were more millionaires along the Mississippi than there were in the rest of the world, or the rest of the United States. The wealth was there. The wealth was all about agriculture. Mm-hmm. What happened during those last 30 years and the beginning of the 20th century was agriculture got decimated. Almost 50% of the population in the United States was either working on the farms, owned farms, or were working in businesses related to farms. During that period of time, we didn't keep statistics, but if you look at what was happening, we had probably close to 20% unemployment. 20%. The Great Recession, we had 10. Great Depression, we reached 20 a couple times. But during that period of time, the 1870s to the 1890s, we had 20% unemployment. In some ways, it was great because it made people move into the cities. It made people start companies. They began to make cars. They began to make all sorts of industrial equipment, and we began to become an industrial nation from being an agricultural nation.
Right,
But
and that goes to something else I read. This is going to be totally, not completely, but not off the topic, but a different take on just what the Fed's doing in supplying liquidity. Because when they supply the liquidity, what goes up when they supply liquidity is productivity, right? And what's been going down ever since the electrification of the Industrial Revolution is productivity. Because demographically we're aging. We're not, I don't know if it's just because of demographics, but there was a book written by Harry S. Dent, The Demographic Cliff. I read it. It's a terrible book, but to read. But the point is that his prediction of productivity going down, and everybody thinks because technology we're going to have higher productivity. It happened great during electrification, and everybody thinks because of the computer age we were actually more productive. But something I read from the Philadelphia Fed is that it didn't do that much to really increase productivity. And so this type of liquidity and putting money out into the market, it's one way to increase productivity.
Mm-hmm. We're coming to a commercial break. Don't go away. Stay with us. What central banks are being asked to do, not just the Federal Reserve, of tackling income inequality, of combating climate change, digital currencies, and geopolitics. Let's talk about climate change. Why should the Fed why should central banks be worried about climate change?
they shouldn't. They have enough on their plate. They got to focus on inflation, unemployment, and GDP growth. And I'd say those three things are pretty big. Those are big enough to handle on their own. Congress is the one that needs to step up, but that's not for today's podcast or today's radio show.
Well, I think I agree with you, but as they look at inequality, right, and where inequality lies, and who gets hurt, and climate change is people who are on the lower end of the income inequality scale, right? However, the question is how are they going to focus on it, and what are they going to do? Like they tried in 2000 was increasing home ownership by letting the banks create these crazy collateralized mortgages, and they could then say, oh, they only have to pay the interest, they don't have to pay the principal because of we'll make the money. We know how that turned out. So the question I have is, if they're going to do that, how are they going to do that? What instruments are they going to use because they don't lend money to community banks. It's not like the community bank or the credit unions can call the Fed and say, hey, can you buy some of our bonds too? No, they don't do that, right? They're only buying the larger commercial, dealing with the larger commercial banks. So
I mean, if they were going to extract, like, buy the bonds of companies that extract carbon? I mean, that's the only thing I could even think of. But is that smart? Like, that's not their job to do. I would say, again, it goes back to Congress.
No, they can put pressure on banks to make a certain number of loans that are involved with climate change.
They could.
We've seen Congress actually pass laws to restrict or to, when we had redlining or whatever with neighborhoods, we saw Congress do that. Now, instead of Congress, we're beginning to ask the Fed to make those decisions for banks to say, you have to deal with climate change. You have to, every loan that comes in, you have to evaluate the impact on climate.
I believe that's too much to ask. I think it's a job of the Congress to set those parameters, and they have their own banking and finance committee to set those laws and regulations that they want to accomplish.
And I mean, really, who's the biggest climate polluters in the world? Well, it's poor nations. They're the ones that can't afford, they can't afford things, right? They can't buy different technology. The poorer nations are the most polluted, especially if you look in the Southeast Asia area. And so, with a $8.9 trillion balance sheet, we're going to be poor here soon with inflation where it's at, right? And so let's focus on that and not get sidetracked. It's just frustrating.
No, I agree. But the question is, the Fed is being asked to do these things because Congress is not taking care of climate change. The Congress is not tackling income inequality.
Well, yeah, because politicians will do as little as possible, so they don't have to put their name on a vote on anything that could potentially get them unelected, right? And we have the three branches of government. Now we're basically appointing a fourth branch of government here with the Fed to intervene way outside of their lines, as far as I'm concerned. It's like having the Supreme Court make monetary policy. That would not work too well, would it?
Yeah. As Bill Belichick says, do your job.
Yeah, exactly.
And it's, it is something that is not being dealt with at the proper place. But the Fed has so much power over banks and where money can be invested and done.
Right. But after I read an article the other day after the George Floyd, the banks got together and said, we're going to, Jamie Dimon led this, they're going to not donate, but they're going to raise $32 billion to give to community banks. And there was an article about a lender who worked in a black community down, I think, in north or South Carolina. And he went and met with Dimon and asked him, and he said Dimon was completely transparent and, very genuine about, they're going to do this. And they lent this bank to backstop this bank. I don't know to what tune, but a good chunk of change so they could lend money in that community. And so people could get small business loans and those type of things to do that. And we know that stuff works if it's done right, because we have these companies that do what's called micro lending that lend in really, really poor countries and done really, really well. So there is some incentive that could work to help bolster the people on the lower economic rung to get them, build them up.
So I think we all agree, as the three of us discuss, that we don't think it's the job of the Fed to tackle income inequality. We don't think it's the job of the Fed to combat climate change. But the reality is we have 3 votes. That's the reality. And I've not had a call from Joe Biden to ask what we should do. I haven't had a call from the senators asking what to do. Talk to Congress.
I thought Powell called you the other day.
So the question then is really, suppose this is pushed onto the Fed. How do you respond as an investor and as an investment manager? What do you do? How do you deal with this?
That's a good question.
That's a great question.
First of all, be dependent what you're investing in.
It's going to have a significant impact on what you invest in.
Yes.
It's going to have it. Dealing with income inequality is some of that's going to have an impact on what's loaned to and what's not loaned to, the same as with climate change. That's going to change the investment scenario. And so portfolios have to be adjusted to take advantage of that and not to be disadvantaged by it. That's where we're really headed with this. And while the three of us disagree that that's the purpose of the Fed, if that's where the Fed ends up, that's going to affect our lives. That's going to affect our investments. And we have to be ready to deal with that and deal with it with client portfolios. How do you explain that to clients as well?
Well, I think it's kind of like the school loan crisis, right? You got, what, $1.9 trillion in school loans out there. Is that something the Fed should get involved in, helping kids pay off their college?
That's
right.
That's true.
I mean, small business loans, I don't know. I mean, should they be helping get involved in those type of things in the Small Business Association that does small business loans?
I mean, all those are questions that are coming up, and all those are going to be questions that will impact our client portfolios.
You know, and I'd rather offer solutions, but right now I feel like all I have is complaints. You know, because I just feel like the Fed's starting to create, and this is, you know, this comes at the aftermath of 2008. I feel like it's creating fiscally irresponsible companies that think they're too big to fail. I mean, even, and you just brought it up with the student loan crisis. I mean, it is so easy to get $100,000 or $150,000 to go to a public university, but for that same individual that maybe doesn't want to go to school and wants to open up a business and needs $10,000, $20,000, that's virtually impossible. And so I personally wonder if the Fed is just getting to the point where they're losing scope of what they should be doing, and they're getting off into the weeds. And it's, you know, they got $8.9 trillion. I've said this a number of times. They got $8.9 trillion to worry about right now. They don't need anything else on their plate.
But as they offload that and as they tighten, that too is going to have an impact on client portfolios.
Right, but as they tighten, right, who's getting hurt? I mean, in the tightening right now, just who's getting hurt? The lower rung of the economic scale is really getting squeezed, that they're starting to tighten their belt. So I don't know how and what incentives what they're going to do to try to alleviate those type of problems.
Yeah,
and how it's going to affect investments and client portfolios. That will remain to be seen, just like it remains to be seen with cryptocurrency, whether cryptocurrency is going to be a serious challenge to these centralized banks.
And even
we haven't gotten there yet, right? If cryptocurrencies really do take off in some manner, I don't know, I don't see it happening anytime soon. How is that going to affect the federal banks all around the world?
Is the Fed going to go digital?
You know, this is something you and I were talking about. There's places now that will not take cash.
Yeah.
You have to use a credit card, or you have to use a cash, what do you call it? The cash app.
Yeah, Venmo.
Zelly.
Zelle, that's another one.
Yeah.
Venmo.
Venmo's the big one.
Square. All those.
Apple Pay.
People will take those. They'll take credit cards, but they won't take cash. I mean,
unless you have a pot store, because you can't take it.
I actually went out on a date on Monday, and I brought only cash. You know, it's just better to do cash. You guys know that. And I go to pay, and they say, no, we don't accept that here. We accept Apple Pay and credit cards. And I'm like, what's going on here?
Okay, so let me summarize. The Fed's being asked to do an awful lot. What that means for life, what that means for investments, it's going to have an impact. And that means portfolios need to adjust for it. Each of the securities that you hold needs to be examined in detail as these changes take place, because some are going to be to an advantage and some are going to be to a disadvantage. And that's something that needs to be covered. We're coming to a commercial break. When we come back, we're going to talk about this whole concept that we heard about at lunch. Have you changed?
About money with your AFC team, Mike, Chris, and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
Three of us were at a lunch hosted by Alliance Bernstein, and the main speaker had this to say. In summary, and he talked about it for half an hour, 45 minutes, but in summary, this is what he had to say. He said, one, the clients were very different in where they were before COVID. They had a certain outlook on their investments, on their life. Then came COVID, and their outlook on investments, their outlook on life changed. And now we're coming out of COVID. Clients' views on life, clients' views on their investments has changed again. Clients are no longer the same as they were pre-COVID or during COVID. That was what he had to say.
Yeah, he said clients are more project focused than planning focused and investment focused. And I was like, maybe some, but I wasn't really buying it.
And it's interesting, you know, if you've watched the news or listened to the radio, there was a story sold that everything was going to change post-pandemic, right? There was this new normal. I mean, how many of you, I mean, I know you guys have heard this, the new normal. Like how many articles have written that? How many different places have talked about how everything is going to be completely different than it once was?
You know, the internet was like that, you know. I can remember back to those times in 1998, 99, when they said brick and mortar was going to disappear, times were going to change. And I kept thinking, if everybody's going to take the information highway instead of the normal roads, wouldn't that help a lot for commute hours?
Remember they said that nobody's going to go to an office. They said that back in
No, they
98.
didn't say that. That was my
What?
my take on the information highway.
Right,
I've
right.
heard that
But
too.
no, they said that, Mike. I remember people saying that back in 98, 99 when the internet proliferated and people were all, the high speed finally started coming up. People, nobody's going to go to an office. Everybody's going to work from home. I'm like, really?
They were really ahead of their time.
And then, well, they tried it at Microsoft, and then it didn't work. Is it bring everybody back in the office? So
Well, how many companies have done that? How many, especially tech companies, have brought everyone back in? I mean, we're back in now, and just a few months ago, we were saying, I don't know, we'll be here once, twice a week. And
You and I are in the office pretty much. Al comes in once in a while. Comes in the third Tuesday of each. Sarah was in the office today. I mean, she was in the office because she spilled water on her computer and the computer wouldn't work. And so she came in to get another computer. But Sarah comes in a couple times a month. CJ comes in a couple times a month. But our work schedule has changed. Will it continue to change? Will our time in the office really change? What do you think?
I think things are going back to normal.
yeah, eventually things will go back to normal. I don't think we're going to continue to work from home forever. And like the guy said, what did he say that had his office in where are they, in Kentucky, was it? No, Nashville, Tennessee. Yeah, excuse me. And he said that they can get people to go in 3 days a week. Now they got them back 4 days a week. And he said we can't get them 5 days a week. Well, who went in 5 days a week anyway? Everybody took Friday afternoon off anyway. So really, how much has things changed? You know. So I don't think, and I don't see clients. I talk to a lot of people, and I don't see that changing. I mean, if a client's retirement plan is, I really want to buy that second home in Florida, that's just normal business. If a client's trying to sell his business and do a succession plan, that's just a normal part of the planning, a part of the process of what clients need to do, what's right in front of them, right? And that hasn't changed, and it hasn't. I don't think COVID's made that change or accelerated that process. In my views of what I see.
So one of his points was that people now fear, and the time element, and where people had time before, COVID's made them want to go right away. And some of that, I think, is valid. I mean, when you look at what people want to do, they want to get out. They're going to baseball games. They're going to, well, some people are going to baseball games. It's no, but it's people are getting tired, or a lot of people are getting tired of having been homebound for a while.
Yeah.
Will that dissipate? That's the big question, I think.
Well, didn't they say that people, they bought bigger homes, they tried to expand their home and put in home office and put in more space, they realize that they're going to be spending more time at home?
Finish that basement.
Yeah, so I think that's right. It basically created a housing boom because in the lumber, where we had the lumber shortage, right? Because the lumber company, the big one up is right up in British Columbia, they basically said, oh, nobody's going to want 2x4s during a pandemic. Oh, dang it. Guess what? People want more 2x4s during a pandemic. We don't have the supply because we stopped making them. So that caused a huge shortage of 2x4s and dimensional lumber. And so people have expanded their houses and done those things. And I think that I think they're prepared to stay at home more. And I think the other thing is that if they were on the fence of retirement, I think COVID might have accelerated them and they said, oh, the heck with it, I'm done. But other than that, I think people are going to go about their business about like nothing happened in another year or so.
And that story of, you know, the new normal, some companies really did buy into it. I actually have a funny story here of Peloton, and I call it the story of mismanagement. So during the height of the pandemic, if you're not aware, Peloton saw a huge surge in demand for their stationary bikes. And to keep up with production and avoid the issues of the overseas supply chains, they bought a 1 million square foot factory costing close to $400 million. And then it was all set to be finished by this upcoming fall. Well, then that's until they realized that this COVID surge had started to slow down and things are going back to normal. Well, this huge miscalculation in demand and shift in the market was so costly to Peloton that the company, worth nearly $50 billion a year, about a year ago, is now laying off thousands of people. They're having to borrow money to cover this factory. They're not even going to finish the factory, and they're going to sell a minority stake. And I guess this is just a reminder to me that businesses do emerge from these crises, and to build a permanent production facility, thinking that this demand is going to run on forever, it just goes to show that some people bought into the story.
Yeah, and I think that that's important when people think about their investments and their investment portfolios, to evaluate what's real and what's not real, and what's going to continue and what's not going to continue, because there will be changes. And we've talked about COVID being the Pearl Harbor moment, but those are changes in technology and lifestyles and demographics, and there will be changes, just as we saw coming out of the Great Recession. I mean,
yeah, I mean, like even our meetings, for example. If one of us is out of town for the week, if we still all want to meet, we'll go hop on a Zoom, right? It doesn't replace being in person. It doesn't replace this right here, but ultimately it will be used to subsidize what we currently have. It's just going to make things better. It's not going to be a new normal.
Yeah, it's like some of the knocks on Kathy Wood. Her ARC fund. They said, were the stocks she had that year, was she just lucky? Were the stocks she had transformative technology, or they just got caught up in the COVID and they're done? I don't know.
In any respect, when I think about when I started in this business in 1986, if we would have had COVID in 1986, trying to work remotely would never have worked. I mean, that's changes in technology, that's changes in demographics and lifestyles. That has to be evaluated in its proper form. And that's the reason why you look at everything in a portfolio and see where it is, why it exists, and will it continue into the future.
And it's why you got to look at the CEOs of the company. Are they smarter? Are they done? The insider ownership. I mean, there were some companies that did really well. Procter and Gamble, Clorox, Honeywell. All these companies had increases in demand, but instead of building big factories, what did they do? They made small little adjustments. They had people working 24/7. They turned idled machines back on to meet demand. Right. Some of these companies had government contracts. They found workarounds instead of big permanent changes. So.
And with that, we're going to leave you. It does make a difference for your investments and for your lifestyle.
You've been listening to About Money with registered investment advisors Mike Adams, Chris Yand, and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.